Our lives are comprised of a series of decisions. They range from something as simple as choosing between ice cream or gulab jamun or both, to deciding whether to buy a house or live on rent. In other words, some decisions have massive implications on the quality of our lives. And quite often these are financial decisions. What you need to make the right choice is information. And that's what we're aiming to get you. This is Big Decisions on NDTV Profit, and I'm Alex Matthew. On this first episode, we're dealing with a problem that many of you have encountered, either yourself or with someone that you know, and that is the mis-selling of life insurance products. Over the years, I've heard that these products are the most mis-sold in the financial space in India, and I'm curious about whether my guest today thinks that is the case. I'm joined by Monika Halan, author of Let's Talk Money. Monika, thanks so much for being on the first episode.
Thank you for inviting me. Real pleasure to be here.
So let me start with that first question, because of course I want to talk about what life insurance should do for the individual, but people need to understand why this is mis-sold. If indeed you think that it is, first of all, do you think that it's the most mis-sold product?
I think the best way to look at a problem is through data. And there is some data thrown out by the Ministry of Consumer Affairs, which maps consumer complaints. And sure enough, the highest are in the space of both life and health insurance. So that is one part, that we have data to prove that there are a lot of consumer complaints. And the second is, social media is a good barometer right now, where every time you post something, the sort of response you get on stories of mis-selling is huge. And the third is the meme story. So the minute you start getting memes, like you walk into a bank and you walk out with an insurance policy, you know there is something happening. So I think there is plenty of evidence out there that this is a mis-sold product. You cannot have so many people across situations complaining about the same thing.
Speaking of social media, I posted on one of the social media platforms, in fact, and we could possibly pull that up on the screen. And the responses I got were varied, not just individuals talking about themselves, but talking about the fact that their parents were mis-sold products. I'm hearing about people 75 being sold life insurance products, which is a little ludicrous, if you can call it that. The question I'd like to ask, and why this is important for people to understand, why are these products mis-sold?
You have to follow the money. Look, finally, this is finance. It's not rocket science. You've got to look at why the agent and the bank is selling these so hard. The first year commissions can now go as high as 100%. So earlier, they were much lower, but IRDA, in a series of what it calls reforms, has left the decision onto the insurance companies as to how much they want to compensate the agents. So technically, there is no upper limit on the first year commission that the agent gets from your first premium. After that, subsequently, the commissions drop to about 7.5% a year. So imagine, let's say that person is not even getting a full 100%, but is getting, say, 40% commission or 50% commission. And from the second year till the life of the policy, the commission is dropping to 7.5%. What is a utility maximizing insurance agent going to do? She is going to hard sell the first time that you buy the product, and then encourage you after 2 or 3 years to buy a new one. Let go of the old one and buy a new one. So you just have to follow the money.
Because there's huge incentive there.
There's huge incentive. And there isn't a product in India or anywhere in the world, I think, where such a huge incentive sits there. Let's compare it with a bank fixed deposit or a public provident fund or a mutual fund. So a mutual fund is a market-linked product, but it has zero front commissions. 2009, Mr. C.B. Bhave, who was the then SEBI chairman, he made the industry swallow a very bitter pill. He did the job of a regulator and said, no front commissions. So if you invest 100 goes to work, minus a small tax that the government collects.
But Monika, I've also heard of cases, anecdotal evidence of individuals coming and saying, hey, you know what, this individual came to me and said, you don't even need to pay your first year. I will pay the first year premium for you. How does that work?
he's paying out of his own pocket because he's getting the entire thing back.
Right.
He's getting that 100% back. And then I would be surprised to see an agent who does that. Okay, usually what they do is they split the commission with the policyholder. I would be surprised to see a person who says, I'll pay your entire first premium, because then he's let go of this big candy that was sitting there. Subsequently, he's only getting 7.5%. Only, but it's a large amount. But
so
yeah, so even 7.5 is a huge amount when you compare it with others.
Compare it to a mutual fund scheme, where you know, and often I've found, Monika, that people don't understand the commissions that are paid even in mutual fund products. We spend a lot of time talking about direct versus regular, but in most cases you're talking about what, 70 basis points,
Correct.
or 0.7 percentage points.
That's right, and that's sitting at the end of the year. It's sitting at when you stay into the policy, it is then that you pay that commission, and you don't pay it, it's embedded in the expense ratio.
Yes.
So it's not going really out of your pocket as you start the product. Your investment amount is not getting reduced. So yes, of course, there's going to be costs in financial products, but I think a smart investor needs to understand what is the impact of that cost on my financial life.
No, certainly, and this is why probably you've heard mutual fund distributors also talk about the fact that life insurance is a much more lucrative product to sell.
But you have to only look at the numbers of AUM to understand that smart investors are shifting away from life insurance to mutual funds. So the AUM are now within hitting distance of each other. Life insurance industry used to be a multiple of the mutual fund industry. It was huge. It was, I think, 3 or 4 times bigger. Now they are both in the range of some 50-55 lakh crore. So there is something about getting the product structure right, designing a product which is fair to investors. Investors then trust it, and you have an SIP book today of what, 19,000 crores?
Yes.
You know, where in the world do you get a risk product which gets people lining up to invest? So this is something actually I have believed for 20 years. I've been part of different government committees. This is what we have recommended. Make the product structure fair so that so there is no incentive to missell, and people then can make their decisions based on the merit of the product.
So, but let's talk about those products, because it's important to know which products are hard sold and missold and why they are. Would it be fair to say that traditional products, which is your money back products, where you say that you pay premium for a given number of years and you get that premium back with a certain amount of interest, and ULIPs, which are unit linked insurance products, which often invest in the equity markets, that these two are the most missold?
I would say traditional are more missold than ULIPs. So look at a traditional plan like a fixed deposit with a small crust of life insurance, and a ULIP with a mutual fund with a small crust of life insurance. The industry is 85% traditional and just 15 or 14% ULIP and 1% what is called pure term policy.
Just 1% of pure term.
Which is the insurance that everyone should be buying, whoever needs to, is just 1%, because that's the best product for the policyholder. But the bulk of the industry is in the traditional plan.
And we'll talk about why in just a bit, but let's talk about why.
No, so just understand the two products. ULIP is still a fairer product than a traditional. The worst is traditional because it's an opaque product. You don't know the costs, you don't even know the return. And the way the policy is sold, you don't understand if there's a rate of return. The way it is sold is you put 1 lakh for 10 years, and then you get an X amount back. So the people are looking at large numbers. They're not doing the maths to see what is the internal rate of return, what is the IRR of this product. It is between 2 to 4%.
Yes.
So what traditional plans do, and people need to understand that, they take government bonds giving 7 and they convert it to a 3% return. You are better off in a public provident fund. It gives you the tax break, it gives you tax-free returns. You are much better off because you're getting,
or even a fixed deposit, Monika.
Even a fixed deposit is better than these products, because look, most people don't stay with the plan. So the 5th year surrender rates, so less than half the people who buy a policy stay in the product after 5 years.
Which is stunning,
No, and the surrender costs gouge away all of investors' money.
And I do want to talk about that in just a bit, because that is a bit of a sticky issue as well. We've established that traditional products are missold, and we'll talk about why these are not meant to, or these are not the ideal option that should be chosen. But there is a role that is to be played by the regulator, and we've witnessed other regulators be very vociferous and very active. I'm talking about the central bank as well as the Securities and Exchange Board of India, to say that the individual must be protected.
Correct.
There was an instance where there was a proposal, and you just mentioned surrender charges. There was a proposal to bring those down, but that didn't take place.
Right.
Is that a disappointment according to you?
I think it's a huge disappointment, because I think people need to understand that these are long-term products and there are costs imposed by the company if you stop funding the policy midway. So if you've paid the first premium and you don't pay the second, you get nothing back. You have 100% capital loss. If you pay 5 premiums and you don't pay the 6th, suppose you've paid 5 lakh, you get 2.5 lakh back. They've gouged out half your money, and till the last year of the policy, you get only 90% of the premiums paid. There is you're not even getting any return back. You're taking a capital loss home even after 20 years. So the companies are able to impose huge surrender costs. And IRDA in December had a proposal to reduce these by just a bit. It wasn't that much, just a bit. I think the industry pressure was such that IRDA has rolled it back, and the new surrender values look exactly the same.
Yeah.
They are the same. So, investors need to ask the agent, what happens to me if I stop funding the policy midway?
Yes.
They need
Before
to see
they buy
face
the
up.
product.
Before they buy the product.
Before they buy the product.
And they have to get the agent to write the numbers down and sign, because verbally they will say a lot of things. You need to get them to write these things down and sign on that with their agent number, so that they stand behind that.
Monika, I could have started this conversation with how individuals should buy life insurance, but I chose to do this part of the conversation because ultimately an individual needs to ask, in my opinion, when they're being sold a product, what the individual that is doing the selling stands to gain. And so therefore, they understand whether or not they're heading down a direction that is not necessarily good for them. One last question before we slip into a very quick break, which is from a regulatory standpoint, is there something that can be done quickly? And of course, a lot of things can be done, should be done, but is there something that needs to be done immediately to resolve certain situations?
They have to make the commissions subject to persistency in the policy. So I'm not a big fan of banning things. Okay, it's a very blunt instrument. Ban this, ban that. No, let products play in the market, but allow the commissions to be such that the longer the policyholder stays, the larger is the commission for the agent. So what the current structure does is it takes a lifetime of commissions and it collapses it into the first year. They should do the reverse, that make the agent win if she can keep the policyholder in the policy till the end of the term.
Right.
Because in that way, you've at least, so you sign up for a product, you stay in the product, and you get at least the return that you should. So that's a very low-hanging fruit to do.
The right thing is made lucrative or incentivized.
That's right. This is finance. It's basic finance. Follow the money. Incentivize. So what are we trying to do? We're saying, let's incentivize the agent to do the right thing, which is something what SEBI did in 2009, to say that a trail commission benefits the investor, the distributor, and the company, because as the asset size grows, everybody wins.
It's fair to say that term insurance is the only product in life insurance that you should buy?
Absolutely, 100%.
But why would you say that? Why separate? And I know the answer, but I think...
No, because when you bundle a product, you're unable to see clearly either the insurance amount or the investment amount. Both ULIPs as well as traditional plans have a very thin crust of insurance. You might get like 5 lakh of a cover for a premium which is 50,000. But a person who can afford a 50,000 rupee cover probably has an income which needs a 1 crore cover.
Yes.
So a term plan it's like your car insurance. You get nothing back if you survive the policy term.
But that's a good thing.
It's great, because should you have an event, your family gets a very large amount. So in your 30s, in your early 30s, if you want a crore of cover, it doesn't cost you more than 8,000 to 10,000 a year. That's it. So the only product to be bought is a pure term life cover. You should buy it online. You should fill the form honestly. You should get a medical test done. Be honest, because you don't want the claim to be rejected.
And it's not true that everybody needs a life insurance product or policy, because this is a very specific thing. What I think a lot of people don't understand is what insurance is meant to do. If you look up the definition of insurance, it is the shifting of the risk from yourself to another entity, which is being compensated for that, and that is the premium which you're paying, which you're not supposed to get back anyway. Right? So who needs a life insurance policy?
So a very rich person, Shah Rukh Khan doesn't need a life insurance cover because he doesn't need to go to work to pay his bills. So anybody who's super rich, other than for tax planning and inheritance purposes, that's a separate thing. But for the purpose of a life cover, they don't need it. You don't need it if you have no dependence on you. You need a life cover if you have people who depend on the salary that you get home every month or every quarter. Once you get financially free, so people want to get financially free, which means you don't need to go to work. You have the assets which sustain you for the rest of your life. The day you reach your fire target, that is the day you have to let go of your life insurance, unless you have a loan. Then you probably need that extra little bit of life insurance. But you don't need life insurance if you have the money to pay your bills till the time that you're alive.
And if you don't have financial dependence?
If you have no financial dependence, so people who are single, plan to stay single, don't have dependent parents on them, you have no need for life cover. So don't buy it for tax planning. There are other products which do equally and actually better than life insurance.
Yeah, or in fact, if your parents, in a lot of cases, the younger folk, their parents have been saving for some time, have had the benefit of investing in mutual funds and other investment assets. They have their nest egg as well. If they're okay, you don't necessarily need to go out.
If you have no spouse or children or extended family to look after, and your parents are financially independent, you have no need for life insurance at all. It is not a product which is in your portfolio.
And it certainly shouldn't be bought just for tax saving purposes.
Definitely not. You have the PPF, you have ELSS, you have a 5-year fixed deposit. If you have a home loan, the principal is also eligible for that ATC benefit. You have a ton of products you can use for that benefit.
But let's talk about the modalities of choosing how you need to do this term policy. How do you determine how much of sum assured you want, which is basically what you get in the event of an untimely demise?
So look, one of the processes is actually to sit with the financial planner, look at how much assets you have, because if you already have these assets, that has to be minused from the rest of the amount which is required. So we use a rule of thumb for shows like this because you can't go into each person's life. So technically, just 10 times of your annual income is good. So if you're doing 10 lakh, and many people watching will be doing more than that, you need 1 crore of life cover. Okay, so those are the numbers, 1 crore, 2 crore, 3 crore. Those are the numbers. But remember to deduct the existing assets from that final amount.
Right. And is there something that is ideal in terms of the payment of the premium? Because there are several options in terms of lumping it up or paying it over a period of time.
If you can do a lump sum, it's easiest in terms of just practicality, that you've got rid of it. You've made one payment, it's out of the way, and you're free. But if you want to do a monthly, it'll be slightly more expensive. But it's not going to change your life in a major way.
The other aspect is when do you review this? This of course is the case with almost every aspect of your personal finances. You have to go back to the drawing board often to talk about what has changed. When do you review the amount of cover that you have?
I think when you open your portfolio every once in a year, I don't recommend more, twice in a year you look at your market-linked products, but every year if you do a revaluation of your portfolio, you should take a look at, what is, maybe your life insurance needs have actually gone up because either there's been an increase in the number of dependents or your salary has become so high that the need for insurance has gone up, or you have taken a loan, so which is why you need an additional cover. Or it could be that your assets have grown in value so much that you're thinking that I don't need that much cover.
So just to make the point absolutely clear, when you have a home loan, why is it a good idea to have a term insurance?
Because unfortunately, if you die an untimely death, your family will lose the home unless they can pay the rest of the capital. So whatever value of loan is left, to that value, you should have a policy, a separate policy from your regular life insurance policy,
Sure.
because the minute the loan is over, you can let it go.
You can let it go. So in the event that you prepay your loan and you get it out of the way,
you can let it go.
you can stop paying your premium.
Yes, but that is why, again, the services of a planner are so essential.
Sure.
Because see, what happens is you will take a loan maybe in your mid-30s. Your salary may not be that high. By the time you're in your mid-40s, you might have paid off your loan, but you've got a very cheap term life cover for the amount of the loan. So that sort of will cover you for the increased salary as well.
Sure.
You might just choose to keep it because you don't have to buy an expensive cover. So term life premiums increase
Over a
as you
period of time,
age.
yeah.
But once you lock into a premium, that it stays flat throughout the rest of the policy term.
The last aspect that I want to delve into is at what point do you not buy? So at what age do you say, no, I definitely should not buy? Of course, it becomes ridiculously expensive.
Correct.
But then it's still sold, which is why I'm saying,
Look, by the time you're in your 50s, mid-50s, I don't think you are buying a fresh insurance policy at all, because by 60...
But you shouldn't.
You shouldn't. At 60, you should have jolly well got your retirement corpus in place, because if you haven't, what you're going to do?
Yeah.
And insurance companies should not be selling to the elderly life insurance policies.
Yeah.
Because, you're closer to the age of dying.
And they wouldn't sell term policies anyway.
Of course
They wouldn't
not.
sell.
Of course not. They're selling these money-back endowment whole life products. Yeah.
Which brings us back to the start of the conversation.
Correct.
But
Right.
Monika, on that note, it's been an absolute pleasure having you on Big Decisions. Thank you so much.
Thank you so much for inviting me.
And well, I hope that this conversation has helped you out as well. This, as I pointed out earlier, is Big Decisions. It's aimed at helping you make your financial decisions with confidence. Let us know what you think in any of the comments on our social media platforms. And stay tuned, lots more coming up in the weeks ahead.